Scott Minerd saying basically because the way that we have negative real yields, a yield minus inflation, he thinks the bond market is pricing in a recession in the next couple of years. Would you agree?
I don't know that I would say the bond market is pricing in a recession. However, it is definitely true that real yields being negative indicate some pessimism in the bond market. I think what's a bit more on point is that the bond market thinks that the economy can only handle a few rate hikes. And after that happens, the Fed will have to back off, and that'll keep real yields negative.
You know, I kind of only half joked last night in the program, Thomas, that Jay Powell's had more flip-flops than a Jersey Shore beach shop. I mean, he went from being sort of dovish to super dovish to being fairly hawkish shortly after being confirmed. The bond market seems to be reflecting some of that change. What do you make about the apparent big change of heart by the Fed chair and where the bond market may be going?
Look, I think in Powell's heart, he wishes he could stay as accommodative as possible, as long as possible, but reality just didn't cooperate. I think certainly he thought inflation would have subsided a good bit by this time. Instead, it's accelerated. And at a certain point, facts are facts, and the central bank has to defend its price stability mandate. So I don't know that he's changed his mind of what his preferences are, or really that it has a lot to do with the confirmation. I just think he's got to react to the facts as they are.
Is there any reason to own treasuries at all right now when you're getting negative return on your money?
I mean, I'm a bond guy, so I have to answer a certain way. No, look, we're very cautious.
Thomas, there's other types of bonds. There's high yield bonds. There's all kinds of bonds, many of which are yielding really pretty decent returns.
Yeah, we're really cautious on interest rates generally. I actually don't. I don't know that I agree that what the bond market is saying, that the economy can only handle a few hikes, and also we're not totally sure that inflation will subside all that much on its own. And even if it does subside, or even if the economy can handle only a few interest rate hikes, then interest rates probably just stay where they are. So there's not a lot of upside to it. You were alluding to sort of high yield bonds, mortgage bonds. There's other places to be that can serve that anchor within a portfolio that don't have to be pure government bonds.
Okay, so we like to call these Opportunity Fridays here at Worldwide Exchange. So where are those areas? Somebody out there that maybe wants to own fixed income for whatever reason, you know, they're older, they just want to maintain their money, they're not looking to grow it as much. Where should they be right now?
Well, so we mentioned one area we like, which is government-backed mortgage bonds tend to outperform pretty well as interest rates rise because there's less refinancing opportunities, and so you wind up earning more interest on the mortgage. That's a good spot to be if you just want pure safety. Short duration high yield, so high yield bonds inside of 3 years or so are also a pretty good bet. The economy is in good shape, earnings are great. Maybe the growth won't be as strong as it was this year in 2022, but there's no real reason to think there's going to be stress in the credit market. So stay in that short range. That should perform pretty well. And we still like, corporate bonds broadly, but those spreads are really, really tight. So, I think being in less cyclical things still makes a lot of sense though.